Have you ever struggled with the decision of whether to invest in stocks or buy bonds? Stocks can be exciting, but they can also make your account balance plummet overnight. Bonds seem safer, but are the returns really enough? Today, in just 4 minutes, we'll break down the key differences between bonds and stocks to help you determine which investment strategy suits you best. The advantages of stocks. Historical data shows that the U.S. stock market, such as the S&P 500 index, has delivered an average annualized return of 8%, 10% over the long term, significantly higher than bonds. You've probably heard stories like Warren Buffett held stocks for decades and multiplied his wealth many times over. That's the power of compound interest. For example, during the 2008 global financial crisis, Amazon's stock price dropped as low as $4 per share. By 2025, its price has surpassed $200 per share. This means that if you had invested $1,000 in Amazon in 2008, it would now be worth over $50,000. The risks of stocks. But high returns come with high risks. The stock market is influenced by economic crises, corporate bankruptcies, and policy changes, leading to potential short-term crashes and significant losses. During the 2000 dot-com bubble, many companies saw their stock prices collapse. Enron, once a global energy giant, went bankrupt in 2001, wiping out investors' stock value completely. The advantages of bonds. Compared to stocks, bonds are much more stable. U.S. Treasury bonds are considered a risk-free investment because the government is unlikely to default. Bonds typically offer returns of 2% to 5%, lower than stocks, but they are a good choice for risk-averse investors. For instance, during the 2008 financial crisis, many investors turned to U.S. Treasury bonds. At the time, 10-year Treasury bonds had a 4% annual yield. If you had invested $10,000 in 2008, by 2018, you would have received about $14,800 in total, without worrying about market crashes. The risks of bonds. Of course, bonds are not 100% risk-free. Corporate bonds can default if a company goes bankrupt. Government bonds are safer, but in times of high inflation, their real returns can be significantly eroded. Which one should you choose as an investor? If you're young, willing to take risks, and aiming for long-term wealth growth, stocks are the better choice. For example, investing $500 per month in an S&P 500 index fund, assuming an 8% annual return, could grow to over $750,000 in 30 years. If you're nearing retirement or prefer a stable investment, of course, you can also combine both. For example, the 60-40 investment strategy, where 60% of your funds are invested in stocks and 40% in bonds. This approach allows you to receive stable bond interest while still benefiting from the long-term growth of stocks, reducing the risk of losing too much capital during market downturns. The best strategy is often a combination of stocks and bonds, providing both growth potential and risk diversification. So, next time you're making an investment decision, ask yourself, do I want steady progress, or am I ready to ride the waves? Choosing the right investment strategy is the first step toward growing your wealth.